Hi, welcome to Module 2, Part 1. In this video, we will explain the different types of investments and state examples of each of investment that is available on the market. Firstly, securities. We will be touching on the definition of securities and some examples of it. A security is essentially a contract that can be assigned a value and traded. Some examples of a security include stocks, bonds, options, and other financial asset. Next, real property. Real property is defined as any structures or improvements that are attached to the land which is not movable. Some examples of real property include land and building. In addition, real property can be either rental or residential. Tangible personal property includes a wide variety of equipment, from small office fixtures to light trucks and buses. It also includes any and all miscellaneous assets that do not inherently qualify for any other class life, such as gold, artwork, and antiques. Tangible personal property is always depreciated over either 5 or 7-year period. Tangible personal property is the opposite of real property, in a sense, as real property is immovable. Moving on to debt. Debt is defined as the investor lends funds in exchange for interest income and repayment of loan in future. For example, a company borrowed $5 million from a bank for a certain reason. In this case, the debt of $5 million will need to pay back to the bank along with interest at a later date. Some examples of debt are bonds and loans. Next, equity. Equity represents an ongoing ownership in any asset after all debts associated are paid off. For example, a car with no outstanding debt is considered the owner's equity because he can readily sell the car for cash. As for derivative securities, it is neither debt nor equity. Derivative securities derive its value from an underlying asset such as options, swaps, futures contracts, and forward contracts. Derivative is generally used as an instrument to hedge risk, but can also be used for speculative purposes.